Welcome everyone back to the series on commodities. I'm trying to help a retail investor that maybe has never done commodities before. Firstly, trying to understand what it is. Second of all, how to invest. Again, none of this is financial advice. Obviously, disclaimer in there. I'm not recommending that you should. Capital's always at risk, but just trying to work out and help you guys. What sectors is it? I know commodities are very cyclical, so looking at the value, what's the different ratios? Is tech overvalued? Is energy undervalued? Will they converge? Is there more downside in the oil price and that sort of stuff? So if you enjoy that sort of stuff, I'm going to bring out weekly/bi-weekly updates on the fundamentals. Fundamentals are the most important thing in terms of when you're investing. It means you won't panic buy. If you know the supply versus demand is strong, there's no reason to sell until that narrative changes. And I think there's a lot more fundamental stories in commodities than the likes of AI, Microsoft, Tesla, whatever that might be. So let's get into it. This is the oil series. Again, be sure to subscribe if you want to keep in loop with the updates. So this is the oil one, and let's get straight into it. So this is the first one. So again, tech is very overvalued. A lot of people are calling it a bubble. It could be a bubble. It might burst tomorrow. It might never burst. It might burst in 5, 10, 20 years time. No one can tell you that. But historically, the price to earnings ratio, it is overvalued, the tech sector. We've seen some absolutely mental, crazy runs in the S&P 500, especially the AI boom. Again, the word AI, is that a bubble? There was a lot about ChatGPT and everything coming out. Have you heard of any more of that coming out? I don't know. That's up to you to think. Could be a bubble, might not be a bubble. We don't know. But you can see here from Tavi Costa, with a $3 trillion market cap, Microsoft is now twice the size of the entire energy sector in the S&P 500. Which generates double Microsoft's annual free cash flow. So these energy companies are cash flowing behemoths. They're absolutely massive. They generate so much cash flow, yet the market cap is twice the size of the whole sector combined. Does that scream that tech's overvalued? Does that scream energy sectors may be undervalued? And will they converge and meet again? Will tech come down and oil and gas go up? Or how is that going to sort of balance? But very, very interesting stuff to start us off. Another look at it. So at 30% of the S&P's market cap, only 30%, but only about 20% of the anticipated earnings, the tech sector's weight is now roughly 8 times that of the energy sector, an even wider gap than the height of the tech bubble 24 years ago. So again, I'm not saying that the bubble's even bigger than 24 years ago for tech. I'm saying the convergence between the S&P 500 from IT, information technology or technology, versus the energy stocks that were prevailing back in the early 2000s, there's a huge difference. You can see there, turn of the century. So again, history doesn't repeat itself, but the saying is it sure does rhyme. Are we going to see these come together? Are we going to see energy absolutely take off? Or are we going to see tech roll over and start to crash and correct itself? We don't really know. But you can see here that they do kind of go in cyclical markets. So are we due a next convergence? I'll leave that for you to decide. Another one that's interesting, Nvidia, absolutely crazy with the AI chip stops. So Nvidia is now worth more than Exxon, Chevron, Shell, Total Energies, BP, Suncor Energy, Marathon, China Petroleum Corp, PetroChina, Cenovus Energy, Imperial Oil, Canadian Natural Resources. Combined, Nvidia is worth more than all these companies put together. So my question is, what would you rather own? Would you, for the long term, for the short term, whatever that might be, would you rather own Nvidia, a share in Nvidia, or would you rather have a share of every single one of these companies? I'll leave that up to you. So CapEx, this is looking at the supply versus demand, getting into the nitty gritty. So CapEx is almost the capital expenditure, the investments into that space. But you can see that CapEx is at a record low. You can see here that it's had its dips, of course, the great financial crisis, and again, dips for COVID, went down to a record low. It has kind of regained a little bit, but even so, we're just above the 40%, still lower than any other time in history. So again, this is percentage of cash flows, and this is the S&P 500, just the energy and materials sector. And you can see there's a record low. It's been underinvested for so long. Again, that damages supply. That's how commodities work. You get a commodity cycle. Normally, you see an absolute lack of investment, lack of supply. Obviously, when there's no supply and still demand, the prices have to go up. When the prices go up, it incentivizes new companies, new mines to come online, new production, and normally it shoots past it. Normally, then there's a way too much supply. And then, of course, too much supply means lower prices and it crashes back down. That's why it's kind of a cyclical market going up and down. So where we are currently, we need higher prices in order to drive more production coming out the floor. But there's just no capex, there's no investment. It's so out of favour. No one's investing in oil. No one's investing in natural gas. No one cares. Everyone's in AI, Nvidia. So is now a good time to be looking. So it's an out of favour sector. Energy stocks are out of favour. Fund managers have less exposure to energy stocks heading into 2024 than any other time since December 2020. Again, during the COVID. According to the latest Bank of America Global Fund Managers Survey, with energy prices slipping, investors went from 4% more exposure to energy stocks than their benchmarks in November to 11% less exposure in December, the largest month-to-month decline since January 2016. They had 23% more exposure to tech than their benchmarks. So these huge fund managers are really getting into tech. They're piling up, they're chasing, and I would say they're chasing green candles. They're very, very heavily leveraged on the tech sector. So if you guys are new, there's a thing called contrarian investing, and contrarian investing is an investment style in which investors purposely go after prevailing market trends by selling when others are buying and buying when most investors are selling. Again, Warren Buffett, we all know, is very famous. He's a famous contrarian investor. So you want to be buying when it's hated. The famous Rick Rule said as well, you can find him on YouTube, absolutely brilliant. Buy when it's hated. Any sectors that's out of favour, hated. Again, uranium 3, 4, 5 years ago, absolutely hated. Now it's loved by the media and people have seen crazy gains. A few other sectors, coal. People hate coal. It's a dirty energy source. We're never going to use coal. Yeah, again, there's some brilliant valuations in there. Oil is, I've never seen oil so, well, prior years, but recent times, never seen it so hated. People don't care. People do not want oil or natural gas. It's such a boring subject and sector. But that is where there's an underinvestment, lack of supply, growing demand. The prices have to increase in order to bring new production on. And we've seen that with uranium. Look in the uranium space, and that's what's happening currently. That's why the price is going crazy and it's going up. So that's where I think value is found. Rather than, it's all about the asymmetrical risk and all about the risk to reward. If you get into the tech sector now, again, this is not financial advice, it's just my opinion. If you get into the tech sector now, let's say AI, Nvidia, yes, you could go up another 50%, but you could also come down 50%. But then if you get in a sector such as oil, let's say the likes, let's just say the big companies, ExxonMobil, Chevron, that sort of stuff, you might lose. It's already hated, it's already near the bottom, the valuations are crazy, and you might lose 10, 20%. But there's darn more upside, 100, 200%, even 50%. So the risk to reward is a lot better when you're finding value. And you're going to find value in those spaces that are hated. So I'll leave you with that one again. I'm a contrarian investor. And again, I look for spaces that are hated. And then when they turn into loved or okay and the media picks them up, that's usually a good time to sell. But again, it's all about the fundamentals, supply versus demand. As soon as that narrative swaps, and that's a good entry, not entry, sorry, good exit. So now looking at the supply, so oil supply reducing. So you can see it, oil finds at the lowest since 1952. We'll look at the demand in a second, but on the supply side, you can see here that exploration hit rock bottom at unprecedented spending curves. So due to that lack of investment, again, no one's investing. These companies don't have money to go out and drill new wells, find new wells, and that sort of stuff. You can see here that the billions of barrels, that's from 2016, right down on the very, very low curve. So we are potentially having a supply issue. We're amongst a supply issue in oil. Again, lack of capex. So global population from 2014 to 2024. 2014 to 2024, 900 million human beings were added to the world. An extra 900 million human beings to the world. Oil and gas capex investment hole is near 3 trillion relative to the 2014 trajectory. You can see here, this is the exploration capital spending. We had a massive surge up here, and now it's just completely dropped off. It's not been sustained. And you can see here, the underinvestment of energy is halved from the reserve life. It is sloping down. So everything's sloping down on the supply side. What about demand? I go one more here. For the demand, so Buffett backed again. This company's gone a little bit up in valuation due to the likes of Buffett investing, the Warren Buffett effect. But Occidental, massive company, the CEO says oil shortage by 2025. Warren Buffett backed Occidental Petroleum is predicting an oil supply shortage by 2025, so only next year, due to the global failure to replace crude reserves at a fast off pace. We're simply not finding enough oil. I heard a thing for every 4 barrels we use, we find 1. So the ratio is not looking good. And again, you're going to be using oil, and there's a lot of stuff about renewables. Check out my other video about the renewables, why I personally don't think it's going to catch on as quick as people think. We can't get rid of oil straight away. People led you to believe peak oil is going to be 2030. I think that's absolute rubbish, and I think it's going to be far past that 2050, 2060. And ExxonMobil thinks that twice. So quoting Vicky, the CEO, we're in a situation now where in a couple of years' time we're going to be very short on oil supply. Noting that some of the 97% of the oil in the world is currently producing its from discoveries made in the 20th century. Yet globally, less than 50% of that crude extracted in the last decade has been replaced. So demand is record high, we're just not replacing it. Emerging market demand. This is India's petroleum consumption 2002-2023, and you can just see it skyrocketing. It's still going up. Every year we're going to be adding to that. I'd imagine 2024 is going to be even stronger. Relentless demand from the emerging markets. Again, more of the supply struggles. So well performance. So this is in the Permian. This is when you're drilling new wells, and you can see here that top countries show surprising perfect production drops since 2019. And you can see there the top one, minus 20%. So from 2019, is this the top of the bell curve that we are rolling over? Is it like with the price response, are we likely to go back up again? Or simply it's been so long, is it going to just roll over and we're going to start coming down and crashing? And if that is the case, we've seen the strong demand. This is just India. Massive demand across the world. Every year it's increasing despite the economic slowdown. So what happens when supply gets crunched? What's going to happen? On top of all that, you've then got the geopolitical risk. Again, you've got the Houthis, I don't want to get political on here, but you've got the Suez Canal and also the Panama Canal. Panama Canal is also having issues with water shortages. You can see the impact of that. So you can see here the ships, instead of going through the Suez Canal, they're having to revert right down the south of Africa and come back around again. It adds considerably longer times. The day rates are going through the roof. And you can see the journey that they're taking. There's going to be a response in price. This is the World Container Index. So this is the container index, but it's also the same for kind of the tanker market with separate different rates. So you can see here that just for the container ships, it increased by 61% to 2,600 per container. And that's day rates. You can see it's just spiking like crazy. So again, rerouting around the south of Africa, it takes longer. You need more ships because again, more is going to be in transporting because it takes longer. Is there going to be a hold up? Let's say we do have the supply of oil. That's number one. If we can do that, if the demand carries on growing, there might be a bottleneck in the middle. Do we have enough tanker ships? Can we transport that oil? To make it even worse, VLCCs, which is the very, very large, the crude oil carriers. You can see here, this is the deliveries per year. So you can see here that we were sloping down 2006, 2007. There was a massive boom, and that's when we got loads of new ships delivered, and the order book came up. Again, it's very cyclical, came back down again, and it's gone back up. But ever since, you can see the order book there, projected 2024, 2025, 26, 27. That's the order book. 2024, I believe there was one ship on the order book to be processed for 2024. We're simply not getting the supply of the crude carriers that we need. And again, these shipyards are fully booked. They're fully booked with all the other kind of ships, not only the warships, the navy ships, but these Japanese shipbuilders, not only many of them closed down prior to the other years, but they've got container ships. Again, that's going through the roof. You've got bulk carriers, the demand on iron ore, coal, grain, that sort of stuff. They're all fully booked. So it takes about 3 to 5 years once you get the order in to actually be delivered, and that's a normal time frame. It might even be extended. On top of that, you've got regulations. Do they use petroleum? Do they use diesel? Well, that's not very nice. It's going to hurt the economy, trucking across thousands and thousands of miles. Are they using electric? Are they using nuclear? people are in limbo. There's no point ordering a $1 billion ship if you don't actually know it's going to abide with regulations. That's why there's a hold up. So is there going to be a bottleneck in the oil delivery market transporting around the world? Again, if there is, and there's a supply crunch, prices will have to rise. And these companies, cash flow monsters, generating so much cash flow, they're now buying their own shares back. So again, it increases the cash flow per share. It's a brilliant way of doing it, increasing value. Exxon, Chevron, Shell, BP paid out a record $114 billion into 2023. Again, this is between a bit of dividends, but also buybacks. You can see the ratio. Normally, massive cash flow machines, they pay back dividends as they go along, quarterly, by whatever it's called in the twice a year. But you can see of recent years, they're starting to buy their shares back. They know that their stock is undervalued. They know it's underneath their enterprise or net asset value of their share. So they buy it back and reduce the amount of shares outstanding to increase their value. And these companies, when you wait for these fundamentals to play out, yes, okay, it might not be the next 2, 3, 6, 1 year, 12 months. It might not be in that time horizon. You might see some downward momentum. You might see up momentum. But these fundamentals are likely to play out over the larger time horizon, 2 to 5 years. So you also get paid whacking great dividends for holding on to this company whilst the fundamentals play out. So if you're in Exxon, Chevron, Shell, I know BP and Shell pay out about near 5% dividend yield. So not only will you get the share appreciation, they're paying you 5% a year to hold on to your stock whilst you wait for the supply and demand to play itself out, and peak oil might roll over and come down. Okay, that's everything I've got on the oil space. So again, be sure to drop me a subscribe if you want to keep in touch with this series. I bring out kind of weekly, bi-weekly of all this any more supply demand news that we get in the market. You can see there in the bottom as well, if you're on Trading 212, or if you're not on Trading 212 and you're in the UK or Europe, I absolutely love the platform. If you use my link below, you'll get a free share up to £100. I get a free share, being fully transparent, but you'll also get one as well, and you can invite family, friends, and also you'll then get the free share up to £100 as well. So thank you very much for watching. Hope you enjoyed it, and I'll catch you in the next one. Amazing. Thank you. Bye.